Hi, today we are discussing chapters from the book Masterclass written by Mr. Vishal Mittal and Mr. Saurabh Basra. The investors will be discussing are Mr. Raamdeo and Mr. Bharat Jayantilal Patel. I'll open the discussion by introducing the chairman of Raamdeo Agarwal Financial Services Limited, Mr. Raamdeo Agarwal, his early life and journey as a businessman and investor, while also including some of the case studies which then will be carried forward to my friend Pratin and Aditya. The insightful lessons from the investor Mr. Bharat Jayantilal Patel will be delivered by Mansi and Darshit. Please watch the whole video to project maximum understanding. Mr. Raamdeo Agarwal was born in Raipur, Chhattisgarh to a landlord family. His primary language of schooling was Hindi. Sir's mother wanted him to become a chartered accountant. From Raipur, he went to Nagpur, where he did his Bachelor's of Commerce. After giving entrance exam of Chartered Accountant, he shifted to Mumbai and took his 5 years. It took him 5 years to become a chartered accountant. While auditing balance sheets, he learns about stock market. In 1980, he starts investing. The source of fund was his brother, who worked in merchant navy and earned about 30,000. After practicing as a CA for a year, he realizes it's not something that he enjoys. He decides to change fields from chartered accountant to equity research. For a year, he works as an analyst for a firm named Aditi Investments. In 1986, Raamdeo Sir published a book named Corporate Numbers. A partnership was commenced between Oswald Sir and Agarwal Sir in 1987. He met Mr. Motilal Oswal due to transportation problem in Lokhandwala complex. The business opportunity which was realized by them for a period of time was to be a sub-broker to Oswald Sir's brothers, who were arbitrage traders. Let me first introduce you to arbitrage trading. During 90s period, we did not have national stock exchange. Rather, there were exchanges spread all over India. Same as that, so say a person buys stock of company Z for rupees 200 from Ahmedabad Stock Exchange. This same company, company Z's stock price in Bombay Stock Exchange is rupees 400. Now, by selling the stocks in Bombay Stock Exchange, the instant gain that the person experiences is of rupees 20. Uh, Yeah, so the same is done. If if the opportunity in Ahmedabad Stock Exchange is more profitable compared to Bombay Stock Exchange, Ahmedabad Stock Exchange was chosen. This is what is called arbitrage trading. Oswald had two brothers. Uh, they would arbitrage trade from Ahmedabad Stock Exchange to Bombay Stock Exchange, and the other one will do the same from Chennai Stock Exchange to Bombay Stock Exchange. They saved rupees 15 lakh by 1981, that is 4 years after the commencement of their partnership. Sir talks about how keeping his firm's book clean was one of his principles. They became brokers from sub-brokers by leveraging rupees 12 lakh and purchasing a PSC card. During the infamous Harshit Mehta scam, the brokerage firm would charge 1.5% commission. Plus, they also used to employ six sub-brokers, which increased their capacity. Right now, the brokerage firms of India charge 0.01% as brokerage fee. So the 90s period was more profitable for brokerage, for broking business compared to what is today. It was during Harshit Mehta bull run, his investments gave him 100x return. The initial amount of rupees 12 lakh invested had become 30 crore. And during the 1992 crash, the 30 crore had come down to 10 crore. Until he reserved the portfolio in 2013, his capital of 12 lakh had become 700 crore. By 1994, they had started institutional brokerage. So says, I'm I'm very enthusiastic about reading balance sheets. He would analyze the balance sheets in by these five metrics. There were capacity, location, utilization, cost structure, and profit structure. Now, let's understand how can a balance sheet be judged based on capacity. So here I have attached an example of a company. So we can see that the net block turnover ratio of this company is increasing. That can be due to two reasons. Here I'm just talking about two reasons, but in the real world there can be many reasons. One being business sees near-term growth in demand for its product, and so it starts doing capex or increase its assets. Or it could also be, I'm sorry, or it could also be doing brownfield expansion. The growth in assets is proportionally equal to the growth in revenue. So the creation of these assets is called increasing in capacity. If the business is already at its full capacity, how much revenue it's generating, or if it's doing new capex, how much revenue does it how much revenue does it think that it can produce? So that's how the metrics go for capacity. Now let's come to location. Say a business is situated in a location near to its dealer, it's able to reshelf its products faster than its peers. Business by location, it's by locating itself to its closer to its raw materials, can do backward integration, which can lead to lower costs. These are some of the benefits for a business to be situated in an attractive location. Now let's shift to the third metric, that is utilization. Utilization would be how well can the business utilize its capacity. As the business reaches its maximum level of output, say the business's maximum level of output is 75%, but yet it's producing 60%. Now slowly the business expanding the rest of 15%. This can be due to many factors. The whole industry is seeing demand. The second factor would be there is a strategic contract the business signed. We can also discuss some of the red flags that are if the business starts the capex cycle but has not been working in its full capacity itself from 4 to 5 years, this can be considered a red flag. As in, why would it do capex when it doesn't even see the full demand to employ its full capacity? But of course, everything has to be taken with a pinch of salt. There could be so many differences that could arise in the real world. This is a hypothetical example. Now, the fourth and the fifth metric are cost structure and profit structure. First, let's analyze profit structure. To understand if a business is trading business or a manufacturing business, that decides the profit structure of the business. Yeah, so I'm sorry, let me rephrase that for you. So first we have to decide if the business is trading business or manufacturing business, which gives us an idea what would be the profit structure of the business. Say it's an say it's an trading business, so its working capital load would be lesser compared to a manufacturing businesses. Uh, how the second metric would be to understand how much of core or non-core assets the business holds. The trend of gross profit margin is increasing or decreasing. To understand the factors, to understand the factors of rising gross profit margin are permanent or temporary. Gross profit margin is revenue subtracting cost of goods sold divided by revenue. Analyzing cost structure. Does the businesses in near-term future have scope of becoming a monopoly or economies of scale or operating leverage. If the business becomes a monopoly, it resides I'm so sorry, the word is uncontested and can charge any amount it suffices. By becoming an economy of scale, it can pin down the cost after every output. By having operating leverage, that would be having minimum variable cost and enjoying high profit margin. Evaluating the future of the company and the competition it can attract. Learning about its power to withstand the competition is what these four metrics to analyze the balance sheet can help us. So I would like to talk about a phrase which I enjoyed a lot in this experience of reading this book. The phrase goes, I think that the bull run happened for us only, just like Y2K happened for India only. It was in the bull run which lasted where Mr. Raamdeo Agarwal was able to 100x his return, just like how Indian IT firms were able to create a uh, dominating stage between the global IT players. So let me first introduce you to what was Y2K scare. Scare was programmers used a two-digit code for the year instead of the now standard four-digit one. At that point of time, data storage cost was high. So the coders left out the 19 from 1918. So the first two digit 19 were left out. As the year 2000 was approaching, the fear that the double zeros would be interpreted by the computers as double zeros of 1900 rather than 2000. Fear was that the airline reservation system would throw out all scheduled flights because of the date mismatch, and banks would end up deducting interest instead of crediting it. The Indian advantage, the Indian advantage of this was that Indian students, or may rephrase that, the Indian programmers were well equipped with the computer language COBOL, which was outdated in American universities, but large institutes of America still used COBOL as their main operating language. Now, COBOL's skills were in great demand to alter through millions of codes to fix the bug. The opportunity gave Indian IT firms the business of $8.26 billion. They were being Now let's focus on building. Now, Sir is asked about the brokerage firm. So, I would like to introduce you to that too. The insights that I learned when I was reading this portion of the chapter. They were being conservative in their they were being extremely conservative in their early days. Hence, the initial capital deployed by them was just for stationery. The accounting was done by themselves. Sir says, and I quote, there was struggle in the initial years, but if the concept is right and you have a strong determination, you will succeed. End quote. Sir believes in the power of delegation and it says it's a key to make an organization successful. Um, the growth was due to tailwind in 1990s boom. Sir says that he hadn't, I'm sorry, let me rephrase that too. Sir says that he hadn't struggled to accept the fact that he was an USD billionaire as it was what happened to him was very fast and he was unable to accept that mentally. Sir is asked later how he was able to maintain the fire in the belly after earning such a huge amount in his initial years itself. Sir says it's all about the growth mindset that keeps him going, and says that it's about excellence rather than the actual numeric figures. He says this growth mindset is one of the metric that he uses when he analyzes companies' management. In 2003, they decided to split the company from yeah. In 2003, they decided to split the holding company into an operating company, which is the brokerage house, uh, and a and the holding company had the portfolio and BMS. The brokerage company was named Motilal Oswal Financial Service Limited. In 2007, the brokerage company got listed in the stock market. Initially, they had to be listed for 2,000 crore market cap, but they got listed for 7,000 crore market cap. After the crash of 1992, Ramdeo Sir, Ramdeo Sir had become extremely research focused. Now, the top line of the firm was 10 crore, while the bottom line of the firm was 2 to 3 crores, about 2 to 3 crores, out of which 25 to 30% of the gross revenue, that is 70 lakh rupees, about 70 lakh rupees, was being used for funds to fund research. The research office was bigger than their corporate office. That's what Sir says. Which is why in 1992 crash, where 90%, where 70% of its value was wiped down. That is, it went from 30 crore to 10 crore. But in 2008 market crash, the portfolio value collapsed by 50% only. So the portfolio value went from 500 crore to 250 crore. So says that he is inspired by Warren Buffett, sir. Uh, he would always work on his principles. After he discovered Warren Buffett, sir, he read all the letters he had wrote. And the strategy that he developed, that is QGLP, Q which stands for quality business and quality management, G stands for growth, L stands for longevity of growth, P stands for price, which is buy at a reasonable price, is completely inspired by Buffett, sir, where G is where Ramdeo sir emphasizes on growth more compared to Warren Buffett, sir. It's also said that Raamdeo Agarwal sir is Indian Warren Buffett. Sir is asked a question as of why did he. So moving on. Sir is asked a question as of why did he not cash out given the crazy nature of market. Sir says, as he thought, the story was still existed and blames it on ignorance of ignorance. There's a statement he makes saying that the competition was between the bull and the bring. This can explain. This can be explained. This statement can explain us the vigor of 1992 bull run, which had the stocks which had no terminal value was skyrocketing, and question was rather were my valuations of this company wrong, or am I losing the battle of extraordinary returns due to my own conscience? He wasn't that scared as the stock he invested in was fundamentally strong. Uh, so what I mean to say by this is he wasn't scared of the market crashes because he always invested in fundamentally strong companies. He believed in clean and focused operations, and he would not be leveraged in the market. And this was the reason why he did not cash out, even though he thought that the party is over, but he still wanted to stay and see what more can be gained. First, let's discuss what Sir says. Sir's insight is that you should never be leveraged in stock market. So let's understand the horror of being leveraged in stock market. So say there's a person A investing in company Z. The investment value is rupees 10 lakh by 2007. I'm sorry, that is in by 2007, the invested capital is 10 lakh rupees. The stock price is rupees 100, and the shares he bought by his own money were rupees 10,000. I'm sorry. 2007, the company's stock price rises to rupees 900, and the shares that he bought had a gain. But he also thinks that maybe now we can double the money by taking leverage, and so he decides to take leverage of rupees 1,80,000. Sorry, that is 1 crore 80 lakh. Um, Now that after buying 20,000 stocks on leverage and the 10,000 that he already holds, the total invested capital had become 1 crore 90 lakh. So now, rather than his estimates, the market takes a reversal. In 2012, the price is 199 and it decides to exit. The loss that we had to face was the loss that he had to face was 1 crore 40 lakh 20,000. So the second table, please focus on the second table. Here, the profit that he had was rupees 9 on his money, on his own money, because he bought low and sold at 199. Whereas for the leverage shares, he bought at a higher price and sold at a lower price, because of which he had to sell a loss. Uh, so after deducting the profit from the loss, he has to pay 1 crore 30 lakh 30,000. That's a 53% destruction of his portfolio. This 3 lakh 40,000 3 crore 40,000 90. I'm so sorry. So please focus on the third table. That is 3 crore 40,000 40 lakh 90,000. Here, uh, the total average that he took was 1 crore 80 lakhs, and the interest that he has to pay is 15 lakh 30,000. Now, this he takes this leverage loan for 2 years. So, totaling the amount he has to pay 340, 3 crore 40 lakh. This is after deducting the 99 lakh 90,000, thinking that he would use that amount to pay his dues. So even leverage can be a double-sided sword. Um, it can maximize the profit or it can also maximize the loss. That's why Sir advises us on to never take leverage. Now I would like to bring the focus on the now I would like to bring a focus on the case studies of this chapter. So the first case study we are going to discuss is of Vyasya Bank. So had bought 2,500 shares in 1991 on the advice of a professional client based in Chennai. He had not even read the balance sheets and he bought it at rupees 20. Um, uh, and then the stock went to rupees 2,000. Then the stock fell from 2,000 to 500 and he passed a sell order. But what happens is the delivery parcel gets lost, and at that point of time, a transaction took place in physical share basis. It takes him another 6 months to get duplicate shares. He had to pay additional 100 rupees as a penalty. By the time the parcel reached its its actual location where it had to reach, the stock price had become 2,500. So faced a 100% return. So the insight that we learn from this case study is sometimes by doing nothing, you can face extravagant returns. You can also say this as a stroke of luck. But mainly, what I understand from this, it's buying and holding stocks which are strong in fundamentals can do give you good returns. Now, moving on to the second case study, that is of Hero Honda. The story of Hero Honda. Since 1985, he had been aware of the company, and he himself was the 90th allottee of the motorcycles. In 1996, he bought few lakh shares of Hero Honda at rupees 30, inspired by a book named Value Migration. So let me elaborate further on the topic value migration. Value migration is when customers get attracted to a product which can better cater their needs compared to the static business models, who would not change or distance themselves for their customers ever changing their needs. So in case of Hero Honda, the trend had shifted from geared scooters to motorcycles. There was now thrill in the business from 30 kilometer per liter. The mileage has shifted to 65 kilometer per liter. Supply was lower of these motorcycles compared to the demand, and so there was premium involved in the price, which was about 35,000 to 30,000 that you had to pay. The motorcycles were extremely aesthetically pleasing. Elaborates that he liked the company quite much. He invested 70% of his portfolio rather than his normal 2%. And even from there, that is, even from after investing 70% of his portfolio, he kept on averaging up in the company. He claims that company was growing by 50%. It was giving high ROE. It was giving high ROE, high growth, it was had very good management quality, and it was paying hefty dividends. The market never gave it P more than 20, while its profit kept going, was increasing in by 25%. Before any investing, before generating any good ideas, you have to first envision them. So, also, he gives an example that he was able to envision the merger between the two giants, Hero Cycle and Hero Honda. Hero Honda, sorry, I meant Honda had 60% of market share on motorcycle globally, while Hero had the strong networking connections in India. So it was almost evident that the merger would take place. In 2003, when Honda was allowed to sell bikes by its own brand name, at that point of time, the PE multiple had fallen into single digit. Yet Raamdeo sir wasn't in a panic mode. He kept on revising the annual reports of the company when the stock would show weak signs. Even though that news came in 2003, Raamdeo sir was holding the stock till 2014, where he decided to dissolve his portfolio and invest the whole amount in his own schemes, that is, in his own mutual fund house, to show his extreme trust in his strategies business in his business. I'm sorry, show extreme trust in his business. Now, I would like to carry forward this discussion to my friend Kevin.
Thank you, Vidhi. Hello, everyone. I'm Kritin Arora, and I'll be talking about some of the investments of Mr. Raamdeo Agarwal and what we all can learn from it. First of all, I'll talk about the year 2000 problem, also known as the millennial bug. Now, it was related to errors in formatting and storage of data for in and after the year 2000. Now, as the year 2000 approached, computer programmers feared that the computer might not be able to interpret double zeros as year 2000, but it will consider it as year 1900. So, activities that were programmed on a daily or yearly basis would be damaged or flawed, and sectors such as defense, banking, transportation, global financial markets, along with many others, will be affected. Now, about why India. To deal with Y2K problem, one need to know the COBOL programming language. It was no longer taught in many countries except India. Now, it was an old computer language, and the world had shifted to newer programming languages. Blessing in disguise for India, I must say. So the Indian IT sector was basically providing the same services as American tech companies or global tech companies at one-fifth cost. They were producing at a lower price and selling them at a great price. Hence, the outsourcing of job to India was bound to happen. However, as the date turned 1st January 2000, no such issues were faced apart from some minor malfunctions, but Indian IT sector entered into the big leagues. So, so how did Mr. Ramdev play this situation to his advantage? Raamdeo Agarwal's ji's habit of constantly reading articles and newspaper made him aware of the problem that tech industry might face when the calendar turns to 2000. Also, it was an opportunity to invest in it. So Motilal Oswal invested in Mastech and Infosys during the IT boom. The IT companies were available at a PE of around 20, while their profit were increasing at a rate of 100%. Hence, it ticked the framework of growing business at right valuation. Due to positive outlook of the sector, both PE and earnings started shooting up, leading to rally in IT stocks, and Motilal Oswal earned around 15 to 20 times their initial investment in a couple of years. Now, Mr. Ramdev learned from Mr. Warren Buffett, the one he staunchly follows, that one should not venture into a sector for too long, which they don't completely understand. Acting on this advice, he started selling his investment as soon as he felt the valuations were extremely high and the uncertainty regarding the future was looming around the IT sector. Now, this highlights the importance of having a mentor or ideal in stock markets, as his views and opinions might help us down the line. Though Mr. Ramdev made substantial gains in Infosys, that was not the case for Master. Since in order to avoid capital gains tax, Mr. Ramdev planned to hold his investment in Mastech for a little longer. But the stock took a vertical dive as soon as the IT bubble burst, and he barely recovered his initial investment. So here we will take example of Bharti Airtel and CSC, couple of great investments made by Mr. Ramdev. Now, Airtel was a case of value migration and network effect. Network effect are the incremental benefit gained from each new user that join a network. That is, cost associated with new customer is decreasing and profitability is increasing. Value migration in simple term refers to shifting of resources to a new effective product or business which satisfy customer need better than the current state. Example, switching to wireless mobile phones from wired telephones. Now, Bharti Airtel at that time was market leader of telecom sector in India. As soon as the company reached the break-even profit point, Mr. Ramdev did a spreadsheet analysis to come to the conclusion that the company will make around 28,000 crore cumulative PAT in next 6 years. Other favorable conditions surrounding them were increasing cash flow, fixed operational costs, and 10-year tax holiday. To top this all off, all the company was available at a market cap of 5,000 crore. Now, if you average the 6 year projected profit, it was like companies earning profit which is equal to its current market cap, which is brilliant opportunity. Now, since the market was undervalued in 2003, the prices were favorable too. It was another example of framework of buying quality growth stocks at cheap valuation. Other one was Calcutta Energy Supply Corporation, also known as CESC. it was a great investment. The company had monopoly in power generation and distribution in Kolkata. Plus, it was available at market cap of 90 crore. The main issue was heavy debt company had, which was leading to hefty interest payment. Now, being a keen observer, Mr. Ramdev saw that interest rates started declining since 2003 and understood that as soon as the interest rate decreased substantially, it will have a magnifying effect on the earnings. The same thing happened and the profit increased 30x. Now, such opportunities come by when the markets are very depressed. So we can understand the case of CEC from numbers too. Not every time rapid top line growth is necessary for profitability of company. It can be affected by various factors that affect the income statement. So here is our hypothetical company that is growing at a minimal 5% rate top line, but the company's debt is rapidly falling at 10%. And so are the interest rates. Now, since earlier majority of profits was eaten up by interest income, currently companies steadily seeing a decline in the amount of profits that is been taken away, and the overall profitability of company had started to increase, and so are the margins increasing. Hence we can learn that looking down to the minutest level help an investor in catching great opportunities. Now another investment, the investment of McDonald's, was one which shows he is a man of principles. Mr. Ramdeo attended a seminar in Bangalore and understood the power of advertising and brand building. Now, he ran a screen analyzing investments based on advertising spend to market cap. Despite finding out McDonald's might be a good investment given its huge expenditure on advertising and brand building, which was 100 crore in advertising at market cap of 200 crore, he believed one should not invest in sin stock, so he sold his investment at rupees 16 only, the very same price he bought them. Now we'll talk about some other investments by Mr. Ramdev and the rationale behind it. There often come lucrative opportunities in market where one can back superior returns. One just need to have right level of understanding of the value of the company and the price that is prevalent in the market. Another good investment he made was in Birla Corporation in 2003 using replacement cost method. So the replacement value method considers the amount required to replace the existing company as the valuation of a company. So in simpler words, if one is to create a similar company in similar industry, all the costs associated with it will form the part of firm's value. So Birla Corp was available at a cheap valuation of $10 per ton, whereas the cost of setting new plant at that time was $100 per ton. Now, when such opportunities come and it's one of the market leaders, which is valued so cheaply, an investor should add the stock to his portfolio since it's a good business being available at such cheap valuations. Now, Mr. Ramdev believes the market works in extrapolation. So, extrapolation is action of estimating or concluding something by assuming that existing trend will continue. So, say like if a stock is facing a upward rally, people will believe it will continue for a long time, or good times are now, or market is in bull run, irrespective of the global condition, market condition, or condition of the company itself, and vice versa for downward move. So he states that Infosys in optimistic time was being bought even at 200 PE, believing good times to continue. But as soon as the IT bubble burst, the sentiments changed and the company PE derated drastically and company traded at much lower levels. On contrary, in the case of HBCL, the company had vast and well-managed operations, but company wasn't able to generate good returns. This factor didn't arouse the investor, and hence they never showed interest in the stock. So this concept is linked with PE re-rating and de-rating, which will be discussed later. So here's the QGLP process followed by Mr. Raamdeo Agarwal and his company. He has basically divided his investment process into four parts. Q stands for quality of business and management, G for growth in earnings, L for longevity of growth, and P is for price or reasonable valuation. Explaining it in one line, we can say they are looking for predictable secular growth, good quality business run by good quality management, which are a 10 to 15-year story. So, Mr. Ramdev divided all the stocks into three categories. So, first is the great companies. Now, these are the companies with high return, and they can even deploy additional capital, which can generate higher rate of return. So, second comes the good company. They have a high return and on the tangible asset, and thirdly are the gruesome companies, which require vast amount of capital. And as you invest more in gruesome companies, you can see the signs of capital destruction, making it a bottomless pit. So there are about 50 great companies, 300 to 350 good companies, and rest fall under gruesome category. Now, great companies tend to grow slower than their good and gruesome counterparts. But the key aspect of this growth is that it is achieved by consuming very little additional capital over very little additional capital. Over time, given the power of compounding, great companies become significant cash machines with high ROE and high dividend payouts. Good companies grow at a healthy rates, but need larger increase in capital to sustain that growth. Now, like great companies, they too have their competitive advantage and they make healthy profits. However, they need to reinvest that profit into the business itself to make that growth sustainable. Paradoxically, gruesome companies tend to enjoy very high growth rates, but turns out to be a trap. These companies require significant capital for such growth and they earn little or no money on it. So, as for longevity, it is judged as for how long a company can earn above its cost of capital, that is, cost required to bring in incremental capital to find more productive investment opportunities. Factors such as competitive edge and visibility of operations are considered here. Lastly comes the price. Now, price is seen with regard to the value we are getting. To generate superior returns, it's important to buy right stock at right price. The difference between price and the value must be firmly entrenched in our minds. We can use various ratios, DCM method, replacement cost method, cyclicality of sector, and many others to come at the value of a company. So here are some of the investment that Mr. Ramdev mentioned. First of all, is HDFC Bank. Now, HDFC Bank is the best lender, insurance, and mortgage company in the country, which doubles itself in every 3 years. Secondly, comes the Infosys, which has a very competent management and sets industry standards, quality of management, as Mr. Ramdev mentioned. Now, PNG and Page Industry have growing product categories that cater to market needs. And finally, he talks about Maruti, where Mr. Ramdev invested when the dividend payout ratio changed for the company. Now, dividends provide a regular source of income to the investors as well as lower their investment costs if they reinvest them. So, from his QGLP framework, we can learn that along with the right decision making, we need to place emphasis on power of compounding as well. Doing the right thing for long time will work wonders on one wealth. Also, sticking to your investment philosophy and framework, irrespective of market conditions surrounding it, is a key for being a good investor. It's the discipline that pays an investor the most. Now, Aditya will be explaining the further concepts.
Thank you, Kritil. My name is Aditya, and I'll be sharing some of the more learnings from Mr. Raamdeo Agarwal. So, before getting on to any learning, I would like to share a very important concept of earnings of long-term stock market return is PE re-rating. So, the driver of long-term returns are basically two things: the earnings growth or PE re-rating. Earnings growth can happen due to a lot of reasons. Let's say sales growth, PAT growth, and margins expansion, deleveraging, and whole lot of things. But P re-rating takes place due to, let's say, changing perceptions or the business model or business story getting known in the market. So how does this perception changes about a business? Perception can change due to a high long-term growth rate delivered by the company for a very long period of time. The change of discount rate in the market, like discount rate is basically the cost of capital that if it drops dramatically, then valuation of financial assets increase uh, increase thereby, even if the earnings are the same. So thus the PE re-rating takes place at PE rating takes place at a very fast pace, and other assumptions in the valuation and other factors. So we'll see from an example how what PE re-rating plays a role in long-term stock market returns. Let's say there was a stock whose price in the beginning was 20 rupees and its earnings was 1. So its PE becomes 20. And we see the performance of the company over the 10 years. Sales growth from sales compounded CAGR growth of sales is 25%, profit CAGR is 24%, but the stock price CAGR is 35%. If we go from normal market hypothesis that the stock price should have given returns same as per the profit, but no, we are seeing that stock price is growing much faster than the earnings growth. So what is happening here? Basically, P rating is happening here. If the stock price is given 35% annual CAGR returns, then at the end of 10 years, the stock price will be 402 rupees, and earnings at the end will be 9 rupees, and PE becomes 47. So from 20 rupees, the stock has become 402. So basically, you get a 20x return. But of that 20x return, 9x is due to earnings growth, and 11 to 12x is because of the PE rating. So we can see that how PE can really extrapolate your returns over the long term, right? But there's one thing you need to keep in mind, that PE re-rating is not a sustainable way of getting returns. Like as growth will taper in the future, PE will also get re-rated, or some other negative factors will, if set in, long-term negative factors, structural factors set in, then PE can derate as well. And PE cannot grow infinitely. It can grow up to a certain extent only. Whereas earnings growth can be structural as business expands, does capex, and enters into new areas, new segments. Earnings can grow for a very long period of time, but PE can grow up to only a certain extent, right? Now we see what Mr. Raamdeo Agarwal has view on whether PE rating determines your return in long term or not. Mr. Raamdeo Agarwal says that yes, PE rating is very difficult to predict in the future, for the future. So he says that investors should focus on the earnings growth of the company. What is the earnings potential of the company, and buy those companies at a very reasonable valuation, so that, and have predictability of earnings, so that your downside risk is very much protected, right? And not care much more about the what PE re-rating or derating can do to the stock. Of course, if it is at a very high PE and valuations are not reasonable, there are risk of PE derating as well. But he says what always the first focus should be on the earnings growth, then the PE should come into picture, and more focus should be on the earning side. So he says that one of the case study we have is Eicher Motors. It was one of the biggest return giver to Mr. Raamdeo Agarwal portfolio. Like he said, when he invested in Eicher Motors, his PE was 20 when he bought, but he never predicted that Eicher Motors PE will go to 70 when he'll sell the stock ultimately. So, and the bet he took was on the earnings growth. So, so basically, the summary of the thing is the focus on earnings growth should be more than the focus on the PE rating side for long-term returns. Of course, it gives you superior, it gives a superior CAGR to your portfolio, but the focus should be on the earnings growth. Now, see some of the other learnings from market of Mr. Raamdeo Agarwal. So Mr. Raamdeo Agarwal has been a great teacher of Mr. Warren Buffett from very beginning, and he has read almost all the shareholder letters of Mr. Warren Buffett and personally met him also. And he shared some of the key learnings from him. First is to have a focused portfolio of 15 to 20 stocks. Earlier, he said before meeting Mr. Warren Buffett, Raamdeo Agarwal has used to have a 150 to 200 stock portfolio. So what ultimately used to happen is that your mindshare or your focus shifts. You have to give time to each and every company, even to those companies which are not worthy of giving time. So he said that Warren Buffett taught him that you should have a focused portfolio and in of 15 to 20 stocks where you can track each and every thing of that stock. And among those 15 to 20 stocks, those top 10 stocks where you have the highest conviction should make 50 to 60% of the portfolio, because ultimately a bit of concentration helps you in creating larger returns over the long term. Third learning is the reading habit. One of the partners of Mr. Warren Buffett is Mr. Charlie Munger. So, and a lot of people call him as a walking book. So you see, like for being an investor, reading and always enhancing your knowledge is the of utmost importance if you want to be a good investor and have a good path in the long run. Second is we see his views on disruption and outperformance in the market. With regard to outperformance, he says he teaches us the concept of averaging up with your investments. So a lot of people have a habit in market is that cutting down their winners and holding on to their losers. It means like the stock which you have invested in, let's say it gets 2x, 3x, 4x, and people have a habit to sell those stocks and move those stocks into those stocks that which have not performed in their portfolio in the hope that they will perform in the future. But he says that if a company is successful, there's a lot of probability that he has successfully cracked the market, and also in the future it will be this company only who will give future better returns also and future better business performance. So he says even if the stock goes like 2x, 3x, 4x, you should not hesitate from analyzing those business at that point of time and investing more into these stocks, because people get into a bias that if the stock has already gone up to 2x, 5x, 10x, so they think that it won't be giving more returns in the future, it will be giving subdued returns. But returns in the future ultimately depend on the business performance. And if a business has cracked the market, if a business has performed well, if they are in a good momentum, then it's very likely that they will keep doing it in the future also, if everything remains same. Second is he looks for industries which have huge tailwinds. What are tailwinds? Tailwinds are basically favorable business conditions. So we can see from the example of Paytm, like when demonetization happened, so a lot of people shifted to digital mode of payment. So basically, a favorable business condition got created for Paytm from demonetization. So that was a huge tailwind for that industry altogether. And one of the greatest advantage taker was the Paytm. So he says you should find companies where there are huge tailwinds, because let's say if the industry is only going through a bad phase, then it is very difficult to create returns for good company in that industry. Because let's say in paint industry we are seeing a lot of competition coming in. So like if there is a lot of competition, then there will be a lot of things might happen, like price cuts and very other aggressive pricing by the competitors. So the market leader here, let's say Asian Paints, has to act according to the competitors then also, because and even if Asian Paints is a good company and gives healthy performance, but as an industry is very much into competition has increased, the industry is very competitive, there are headwinds in the industry, then Asian Paints might not be stock might not be able to perform in the stock, and business might not be able to perform due to the industry headwinds. So does look for companies which are or industry which are in tailwinds and look for companies in those. So third is he says for disruption. For a disruption, he says that he considered two factors. First is, can China threaten the business model? Like can China dump low cost goods, or they can easily copy the product and thus dump low cost product in the market? And second, can digital threaten its business model? Right? So for digital, like we have seen the cinema halls, the cinema halls, a lot of people have shifted to OTT platform for their mode of entertainment. So like OTT has disrupted the digital platform has disrupted the cinema hall and the theater industry. This is what he want to say, and he says that always check if value migration is happening in any sector. You must have learned what is value migration from Vidhi till now. Fourth, even if there is a big disruption, you get enough time to explore and invest. He says like disruptions are always taking place in the market, right? So one should not get hasty about investing in that disruption very early. He says that one should see who turns out to be the leader, who turns out to the winner, because during disruption, a lot of people come in the market, a lot of people go out. So there is a huge chance if you take a bet and it might not work in the beginning. But he says, uh, observe about what a disruption is going on and be patient. You will get enough time. Market gives enough time to invest in those disruption, research about those disruption, and until and unless a leader or a market leader is set, or a company is set that this has cracked a particular technology or disruption, then until and unless you should not hurry to invest, and you should have a wait and watch approach. Third is concept he shares is about the price and value. So what is price and what is value? Value is basically the intrinsic value of the company based on the future earnings potential it has, and price is something which is right now going in the market, which can be influenced by a lot of things, a lot of short-term factors, and a lot of market factors, economic factors, and it can fluctuate a lot in the short run. But in the long run, ultimately price has to move towards the value of the company if the earnings come up or earnings catch up, right? So he says, find the value of the company and invest at a price which is much lower than the value of that company. He at last he shares some advice for new investors. He said you should have a positive mindset about the market, about the future prospect of the companies. You should not be thinking a lot negative. Have positive mindset. Have believe in the management that they can deliver. Equity is all about investing in the future. There are always some probabilities, and make sure that the more of the probabilities are in your favor. The odds are in your favor. The one who has vision, courage, and patience makes the most money in the market. So you should have the vision that the company, or a vision about the company, courage to hold the stock courage and patience to hold the stock in bad market environments, and thus ultimately that will be the most rewarding thing you will get in the future. We will be rewarded the most in the future. And he said, invest in things you understand and envision about in future. Let's say Mr. Raamdeo Agarwal says, like he could, or a lot of investors say that they are not able to envision about technology in the future. So they say we never invest in technology. Then he understand. Some investors say that we understand about old economy stocks. So they understand in and out of that industry, in and out of that company, and thus invest in those companies only. It is not really that you should be able to understand everything and anything. He says, have a competitive advantage, invest in things that you understand and understand very well. Then you should not be short term oriented about anything. He said long returns are made only over the long term, and they are basically two rules in the market, and which are shared by his mentor or his guru, Mr. Warren Buffett. That rule number one, you should not lose money in the market, and rule number two, that you should never forget rule number one. These are some of the books recommended by Mr. Raamdeo Agarwal. One is Value Migration by Adrian Selowski, Competitive Strategy by Michael E. Porter, and others. That's it from my side, and I hope you have gained value by learning from Mr. Raamdeo Agarwal. From here on, Mansi and Darshan will share their learnings from another great investor, Mr. Bharat Jayantilal Patel, and I hope you enjoy it. Thank you.
Thanks, Aditya. My name is Mansi, and I will now continue this discussion by talking about Mr. Bharat Jayantilal Patel, who was a well-known super investor. Darshad and I will be covering his early life and background, coupled with his investment strategies, along with notable case studies to better explain his ideologies as well as his mistakes. As illustrated in this timeline, Bharat sir was born in Gujarat and qualified as a chartered accountant. His family had a cotton pressing factory for which he later moved to Rajasthan. However, while his brothers had a passion for this business, he did not enjoy it. His friend was working at a broking firm in Mumbai, which encouraged him to look at the stock market as well. In 1983, it was compulsory to have 2 years broking experience to be able to buy a BSc membership. But since he was a CA, that rule was relaxed for him and he was able to get the membership even though he had no clients. By that time, the government decided to liberalize the Indian economy, which is to minimize restrictions and promote autonomy and higher involvement of private companies. Because of this, even though Bharat sir had no broking experience, he got a lot of younger clientele who had just started to invest in the stock market. Initially, when he invested in the market while broking simultaneously, he lost a lot of money, which made him realize that it is better to focus on either investing or broking, but not both together. This is because when you're placing orders on behalf of your clients, it can confuse and influence you, and that would make you go against your own analysis and beliefs just because of the fear of losing money. Because of this, he continued to focus on broking and brought in a lot of corporate clients. By 2003, he had passed the broking business on to his son so that he could focus on investing. During this time period, he developed his initial investment philosophy. Now let's take a deeper look at his investment style. Bharat sir is one of the best activist investors in India. Now, what is an activist investor? An activist investor is an individual or group that acquires a significant ownership stake in a publicly traded company. They aim to change and influence the company from within. Unlike a traditional investor who would primarily seek a return on their investment because of capital appreciation or even dividends, an activist investor actively engages with the management and the board of directors of the company because they believe that they can enhance the company's value by pushing for very specific changes. Activist investors often identify companies that they believe that are underperforming or are undervalued so that they can turn the company around. The substantial ownership gives them the right to influence corporate decision making, and they also seek board representation. Activist investors may utilize various tactics such to achieve their goals, such as publicly voicing their concerns, even filing shareholder resolutions. They engage in proxy fights and even pursue legal action where necessary. As we proceed, Darshit will further explain activist investing along with some case studies to really dig deeper into Bharat sir's specific style. Moving on to how Bharat sir identifies such companies. He read a lot of annual reports in order to understand the core business. He also involved the management and questioned them wherever he felt necessary. Bharat sir was never afraid to publicly challenge or confront the management or a promoter of the company, as he strongly believed that you have to protect your own investment. No one else will do it for you. SEBI and even other regulatory bodies will act. But what if by then shareholders have already suffered the losses? Even though he predicts that it will get better in the future with regulatory bodies becoming more and more active, it is still critical to guard your own money. He believes that it is most important to agree with the vision of the management. If you don't agree with the management plans, if your thought process and personal beliefs do not align with the management's vision, then simply do not invest in that company. Furthermore, if you don't understand a sector, it's best not to invest in it. For example, Bharat sir did not understand the IT sector, which is why he did not invest in it. He understood old economy stocks, such as cement. which is why he focused more on that. Below, we can see important investments Bharat sir made as per the Masterclass book, and we will be going into further detail about some of these. Now, we can move on as to how a bull run can influence the market and Bharat sir's philosophy on how one can invest during a bull run. But to begin with, what is a bull run? A bull run is a sustained period of rising prices and positive investor sentiment in the financial markets. During a bull run, market participants are generally optimistic about the future prospects of any asset, which leads to an increased buying activity and therefore an upward price momentum. In the stock market context, a bull market is characterized by a series of upward price movements in stock prices over an extended period of time. Investors usually tend to be confident about the economy and prospect of individual companies as well, which will increase the demand and therefore the price of the stocks. This demand is a bull run is typically fueled when there are positive economic indicators such as a strong GDP or low unemployment rates and favorable market conditions. These factors create a positive sentiment among investors, leading to a willingness to buy and hold on to assets because they anticipate that there will be a further increase in price in the near future. During a bull run, market participants may experience this sort of optimism and even euphoria, which would lead them into a reinforcing cycle of buying, which will keep increasing the prices. This positive sentiment will also attract a lot of new investors who fear that they are missing out on potential gains. This also fuels the upward movement even more. A critical thing that investors should note is that a bull run does not have a precise duration. It can be for years or it can even be for months. But when a bull run ends, it is typically followed by a market decline, something we call a bear market. These are market corrections. Markets typically have a cycle where they alternate between bull and bear runs. And this is because investor sentiment changes and market conditions change as well. One of Bharat sir's investment philosophies is buy low and sell high. As I mentioned earlier, a bull run can extend from months to years. What happens in such situations, more often than not, is that poor performing companies who are undeserving also seem to get an unreasonably high valuation. Initially, everyone makes money on such companies because of the bull runs, so investors are happy. But as we know, bull runs eventually do come to an end. And when the market corrects, such companies are not able to sustain such a high valuation. And because of that, investors lose money. When a bull run comes to an end, capital erosion can occur as value of their investments decline. This could be because of various reasons, such as a market reversal, where the end of a bull run would signify a shift in market sentiment from optimism to pessimism. This change can lead to a reversal in asset prices, which causes them to decline. And as prices fall, investors who bought during the bull run may experience a reduction in the value of their investment, which is resulting in capital erosion. Profit booking. During a bull run, investors often see significant rises in price. When the bull run ends, some investors may liquidate and lock in their profits. The selling pressure can, however, contribute to downward price movements, which results in capital erosion for the investors who chose to hold their holdings. There is also increased volatility. As a bull run ends, market volatility tends to increase. Higher volatility would mean that there would be larger price swings and increased uncertainty in the market, which can also lead to capital erosion. Investors who are not prepared for these kinds of situations may increase losses because of would lead to their capital erosion. At times when a company is overvalued because of the bull run, there would also be an overvalue correction. In a bull market, prices of certain assets could become overvalued due to investor enthusiasm and because of the market sentiment. When the bull run ends, market participants reassess the fundamental value of such a company. This causes correction in the prices. As an overvalued asset would decline in value, capital erosion would occur for the investors who are holding those assets. Bharat sir advises to buy low at a low PE at an appropriate valuation and sell at a higher PE. I'll further explain this through Excel. First, let's go over some concepts that will give us some more clarity. Let's begin with terminal value. We forecast the business for 10 years, but is the business going to shut down after that? In reality, we don't really know what is going to happen with the business, but we assume that the business is a going concern, which means that the business will go on forever. This is why we need a realistic value by which the business will continue to grow forever. We can take into account inflation and assume growth after the forecasted period to be in line with that. Next, let's discuss the formula of terminal value. This would be the cash flows in the next period upon discount rate minus the stable growth rate. Here we can see that I have taken that formula. Here this is the cash flow upon the discount rate minus the terminal growth rate, which is also the stable growth rate. Next, let's understand what discount rate means. It means the interest rate used to calculate the present value of the future cash flows. Basically, in order for an investor to invest in a company, they would require a certain percent of required returns, which would compensate for the risk that they are taking and the time value of the money. So, when we are determining the value of an investment, the fair value of the future cash flows required for us to use the discount rate in order to discount those future cash flows into their present value today. That's why free cash flow would be net income plus the non-cash changes like depreciation minus the increase in working capital minus capex plus the net borrowing. For this example, we have assumed dummy numbers, and we have also taken dummy growth rate and discount rates. Now, when we look at what we have exactly done here is that we have assumed a discount rate of 12%, meaning that an investor would require that amount of return. And since this is the bull market, we have assumed a higher growth percentage for the forecasted period, meaning that because of the bull run, the company estimates and the analysts at the time also think that the company will continue to grow at 22% for 10 years, which may or may not happen, but that is what has been assumed due to the bull market. Taking this into consideration, when we see the FCFE for 2020, it's 100 rupees and it continues to increase by 22% each year. And that's how we come to 1087 by 2032. When we discount this for the present value, we get these numbers here, which means that 1087 in 2032 is 279 today. And when we continue to calculate what the terminal value would be, as I mentioned earlier, that would be calculated this way. When we take the sum of all the present values that we have calculated in the 10-year forecast, we get 2,185. When we add the sum of all the present value of future cash flows plus the terminal value, we get the value of the company, which is what the company should be valued according to the assumptions that we have made. Now, The truth is that the bull run may last for months or years, but we don't really know what will happen. Now, when we change the growth period, the growth percentage, as it can decline at any point of time when the bear market comes, when we reduce that to maybe 15, we can see an immediate effect on the value of the company, which is what ends up happening. 15% growth may not be less, but it is lesser than 22%, which was what was forecasted in the bull market. However, when we get to the bear market, the value decreases dramatically, and this can lead to losses for the shareholder. When we take a 22% growth rate, that time our price to earnings, here again profit being assumed to be 250, our price to earnings ratio would be 33. But the minute we change it to 15, our price to earnings ratio falls, and that leads to a loss in value for investors, which is why it's important to have a grasp on as to what may happen in the future, and not to assume unrealistically high growth rates that may or may not occur when the market sentiments shift. But how can we be so sure that we would be able to enter or exit the market at the exact price that we want? After all, we cannot predict market movements entirely, and we also need to appropriately manage our liquidity so as to not miss out on various opportunities. For this, Bharat sir tells us about the concept of averaging up and averaging down. As we can see in this chart, that the stock price rallies from 50 rupees to 150 rupees, but then it also falls back down to 50 rupees. If we determined that the stock is undervalued, we need to buy the stock at different price levels when it is still undervalued. Similarly, we should start selling slowly at different price points when the stock is still in the up cycle. This is because when we are buying, to get a desired quantity, we need to ensure that we keep buying rather than believing that we will be able to buy the entire quantity at the singular desired price point that we want. That would be difficult and could also be infeasible. When we are selling, it is better to sell when the market is still in up cycle, because at that point of time, according to our analysis, it is overvalued. But when it is in down cycle, it is harder to sell, because that time we would be in panic, and the liquidity in the market would also be lower due to other people wanting to sell. Additionally, we can take advantage of the down cycle when we exit, because we would have increased liquidity and we can seize different opportunities at that point of time. Since exiting a position on top or the down rally would give us similar average price, it would also reduce our risk. Now that we have understood how a bull run would influence a company, we can move forward to how a promoter can influence a company. For this, I would like to take the example of Raymond. This is a company that Bharat sir owned just over 3% of. A short background about Raymond. It is an Indian branded fabric and fashion retailer which was incorporated in 1925. They manufacture suiting fabric. Raymond said that they are doing a redevelopment for a property, which was of course assumed to be for official purposes. As an investor, one would be happy about this, because the value of the land, considered to be of between 800 to 1000 crores, additional spending of rupees 200 crores would then give them a realization of between 1400 to 1500 crore rupees. But how would someone be certain about the actual purpose of this project? That when Bharat sir asked the BMC through RTI what this property was about, he discovered that it was not actually official activity, but rather a residence for the promoter. The promoter led a flashy lifestyle where he used expensive yachts and boats through shareholder funds. Raymond had a net profit of rupees 197 crores in 10 years. whereas the expenses were close to 330 crores, which is almost a 1.7x. Because along with this, there was also a salary increase of 33.7% for the promoter in just 1 year, which was FY 15-16. Raymond has provided only a 4% CAGR in 25 years. And from this example, we can clearly see how a poor promoter can badly influence the business, and they can also misappropriate funds, which will lead to a loss in shareholder value and capital erosion. This is why it is very, very important that we conduct a detailed analysis before investing in companies. It is crucial to do your own analysis. Often, analysts ask promoters about future growth prospects and projections. But the reality of it being that more often or not, promoters do not even know themselves what the future will look like and what growth prospects will truly happen. It is based on several factors, as we have even discussed previously in the video. Even if the promoter claims to know, realistically, there would only be a 50% chance of them being right, which is why it is definitely not enough to take their word for it. When we take the example of Paytm, the promoter signaled an unrealistic high growth expectation and projection that led to them having a very high valuation, and therefore when their IPO launched, the market corrected their valuation, and this led to a massive loss for shareholders, and it destroyed wealth. I hope that I've been able to explain some key concepts and elaborate on the learnings provided by Bharat sir. Darshit will now continue to provide further insights regarding activism and mistakes Bharat sir made so that we can learn from them. Thank you.
Hi all, my name is Darshit Sole. Now that my friend Mansi has explained you some of the important learnings from Bharat sir, I'll be explaining one of the very interesting style of investment that Bharat sir had followed. And this strategy is different from the regular strategy of buying and holding or trading as well. Because in this sort of investment, we actually try to influence the management of the business to grow the business or remove inefficiencies from the business so that the value of business increases, and in the same lines the returns for the investor or the activist investor increases. So let's try to understand how it works. So first we need to understand the structure that is present between the shareholders of the business and the business, along with the management and directors of the business. So shareholders, which is basically the investor, invest in the business and which is operated by the management. Now, since there are lot of shareholders, like if we say shareholders can be retail investors, they can be FIIs, they can be DIIs. So the number of shareholders are a lot. It can be in lakhs or thousands. So shareholders cannot directly go and talk to management individually. So that's why we have board of directors in place, which is in between management and shareholders. The responsibility of the board of directors is to basically protect the interest of shareholders, to ensure that whatever decisions the management is taking are benefiting the shareholders of the business. So they have influence on the management. This is how a basic structure is. Now, shareholders have certain powers, or when we invest in a business, we get a voting right in the business. For example, if I hold 100 shares in the business, so that means that I have 100 votes. So whenever some important decision is passed on by the business, which is called as a resolution, so at that time, to pass that decision, we need an approval of 51% of the shareholders. Some of the important decisions, like let's say share buyback or the change in director. If we are appointing a new director, then the new director has to be approved by the shareholders of the business, or even the pay, executive pay, that is the salary of the management, that can be approved through passing or through voting rights, where the such decisions require the approval of 51% of the shareholders. Now there can be certain special resolution which need the approval of 75% of the shareholders. For example, let's say the business wants to change its name, or the business wants to wind up, or that is basically closing down the business, or some of the decisions that the board of directors have taken, and shareholders need it requires majority of the shareholders of the approval. So in this scenario, the majority of the shareholders definition turns out to be 75%. So whenever the decision making is involved in certain aspects, the investors in the business can have the power to pass on the whether to approve the decision or to reject the decision. But for that, they require a certain specific majority, which is 51% in case of ordinary resolutions, which are basically the resolutions that are passed on every that are supposed to be approved on every annual general meetings, or 75%, which is more important decisions of relating to the, let's say, survival of the business, or some of the important decisions made by the management, which needs to be approved by the shareholders. Now, how activist investing works is basically, first, an activist investor identifies a business in which they think that they can create value, which is either by they identify inefficiencies which management is not able to tackle or is not tackling, or they have certain growth way of growth plans. They have certain growth plans in mind which management could use for the growth of the business, which in turn will increase the value of the business. So usually the investors approach the management. They tell the management that these are the inefficiencies and you can improve on these inefficiencies. If the management is friendly, they would approve, and they would take the advice and implement those decisions. If the management is not friendly or is rejecting the decisions, then at that time the investors can reach out to the directors of the business and discuss with them that these are the changes or these are the decisions that would help unlock value for the business. Now, directors can directly influence the management either through direction or asking them to incorporate the decisions, or directors can change the management itself. But if the directors are also reluctant in implementing the decisions of the investors, then investors can pass those can basically exhibit power, in the sense that investors have voting rights of 51% in terms of ordinary, or 75% in terms of special resolution. So what investors usually do, activist investor do, is basically they gather the shareholders power by either increasing the number of shares held. Let's say I am an investor, I have 10% stake in the business. I will increase my investment to, let's say, 50% or 51%, or I'll gather other investors, which are basically FIIs or DIIs or other fund houses who own higher number of stakes, let's say 5%, 10%. So gathering enough number of other investors, I would be able to pass certain resolutions, pass certain decisions. Like if the director are not listening to my strategies, if the strategy is good enough, other investors will listen to me. I could nominate a director in the board of directors, which is basically appointing my own director, and which is supported by the 51% of shareholding or the shareholders of the company. Now, by approving this director, this person will be the part of the board of directors of the company. Now, who can influence the management? So activist shareholders typically work in these ways. They either approach the management to improve the inefficiencies, or if they don't listen, they approach the directors. And even if the directors don't listen, they can actually change or add their representation in the board of directors seats, so that their strategies or decisions are heard enough and implemented in the operations of the business. Now, this is how the shareholder activism works. I would like to give you a recent example of how investment fund which is TCI, who has approx $30 billion, who is managing $30 billion, has invested in Google approximately $6 billion stake and owns 0.27% of Google. Now, TCI fund have found certain inefficiencies in Google, and they have highlighted those in an open letter, which is basically creating a research on how Google is not managing its cost properly and how it can improve so that the profitability of the business is improved, which in turn will increase the value of the business. So TCI in an open letter highlighted to Google that they have a very high number of employees, and by analyzing that the employee count of Google has increased by 20% per year in past 5 to 6 years. Then they have highlighted that the compensation per employee is very high, which is approximately $300,000. Again, which is higher, 67% higher than those of Microsoft, and 1.5 times compared to the 20 large companies in USA. Then Google has certain investments, certain portfolio companies in which they are incurring losses to the extent of $20 billion. And not in 1 year, but in 5 years, and they have generated revenue of only $3 billion. And or since Google also generates a lot of cash, it could also return that money to shareholders by either share buyback or in terms of dividend. And it has also the fund has given Google that you can very well achieve the 40% EBIT margin target, which is currently at 39%. So TCI fund also recommended actions to overcome these inefficiencies, which is basically increase the share buyback, reduce the number of employees, reduce losses in other portfolio bets which are making $12 billion of losses, and provide the target for profit margins. And in the same period, Google had layoff in a period near about where this open letter came out. Google laid off 12,000 of its employees, and it also stopped projects like Pixelbook laptop and Stadia, which were making losses. And we cannot attribute 100% to the activism of the shareholders because of which Google has taken such steps. But if we look at the timing of where the letter came out and when the Google took those decisions, Google did implement some of the strategies which were recommended and to increase the profitability and efficiency of the business. Now, looking at how Bharat sir have been actively participating or have used activism as a tool to increase his own return. So this is a wonderful example of Hindustan Composite, which is in the business of manufacturing frictional materials or industrial bearing and insulation products. Now, what the company did was they sold a land parcel that they held at rupees 600 share value. So ideally, company should use the money earned in either business growth or return that money to shareholders either through dividend or share buyback. But what the company actually did was they invested by themselves in portfolio management services and tax-free bonds and other financial assets. And in the AGM, management was posting that we are able to achieve 3% of growth. Now, Bharat sir asked went to the AGM and did a detailed research and shared to other investors in the AGM that why the business is only growing at 3%, why the industry grew at 10%. And he asked many such questions to the management, and management don't like to be held accountable, especially if they are this thing that I have noticed is whenever the management is inefficient in in operating the business, they don't like to be held accountable. And this sort of accountability and speaking in AGM what influenced the management, and management bought shares from Bharat sir at a premium to market price. And this is how Bharat sir, through for his investment, was able to generate excess return, which were actually greater than the return which would have generated from selling at market price. So this is a great example of an activism, basic level of activism in an investment, where we're directly asking management about the inefficiencies, and they simply bought back shares. Now, one of the great investment that another example of investment that Bharat sir made into activism through activist style of investment is through Rookvilla International. So in this, this is another way in which he was actually not able to increase the revenue of the business through activism. So Rookvilla International was into rubber thread industry, and they used to manufacture rubber threads. It went into bankruptcy, and it was filed to Board for Industrial Financial Reconstruction, which is basically a board formulated by the government where the bankrupt companies can go for resolution process. So Mr. Bharat saw the company. He saw that the factories are running very efficiently for a company that is into bankruptcy. So he found the company to be good, and he bought the shares. So he spoke with the promoter and bought the shares from the promoter itself to run the business. And while he was onto it, he ensured that less number of people were involved in becoming the majority of the shareholders, to ensure the concentration in power that he could maintain, so that he can influence the management of the business. Post that he changed the management, the new management was able to turn around the business from 35 crore revenue to 200 crores of revenue. They increased the capacity 3.5 times from its existing capacity. So this is and which again turned around the business completely. And if you this scenario happened in around 2006 to 2007. So if you look at the stock price over here, it was only rupees 4, which was the time of bankruptcy. And after Bharat sir made an investment, changed the management, and improved the operations of the business, by 2017 the share price reached a high of rupees 90, and we can see the returns that are generated are nearly more than 20x. It's 20 to 23x of the amount that Bharat sir was able to generate through activism, which is basically buying a bankrupt company, changing the management of the business, turning around its operations, and generating 20x plus sort of returns in investments. So this is the impact that activist shareholders have when they you try to make the business more efficient and unlock value in the business. So these are the major activist shareholding that Bharat sir had done. Now we will be talking about some of the mistakes that that we can learn from Bharat sir, that he has made in his course of investment. So one of the let's try to understand that with the help of a case study. So Bharat sir invested in a business called Jyoti Investment. The investment rationale was the business is very old, so it's an established business. The business has good amount of land assets, and it is into the business of water pump supply to irrigation infrastructure projects. And as the infrastructure development is happening in India, and there's a lot of infrastructure development that is yet to happen. So there is a growth opportunity in the business. Business has good amount of assets. So the rationale was that the business will grow. It has it also holds a good ample amount of land through which the business can benefit. And the promoter was very much enthusiastic about changing the business and growing. So how the promoter intend to change the business was, they had a vision to increase the turnover of the business to rupees 500 crores. Now, this is where one of the important learnings comes in, that balance sheet should justify the business, should justify the projections that the company is making. Since the company wants to make 500 crores of revenue, it should have that much amount of liquidity, that much amount of assets, that much amount of capital to generate that sort of business. So let's take an example. Management said that they wanted to generate 500 crores of revenue. now to generate 500 crores of revenue. And Jyoti was a trading company. So on an average, trading company margins are anywhere between 8% to 15%. Now I've taken 10% on average. So to generate a turnover of 500 crores at a average of 10% gross profit margin, it will need to buy 450 crores of materials. Now to buy 450 crores of material, company needs to, and the Jyoti Limited had a capital of only 16 crores. So to sell 450 crore worth of goods at a capital of 16 crores, the company will have to churn capital 28 times. What that means is the company buys inventory, then it holds for a certain period of time till the time it is able to sell, then it actually sells, then there is a credit period of anywhere between 10 days, 30 days, it can go up to months. And after that, it receives cash through which it again buys the inventory. So this is one capital churning cycle. Now, now if you have capital of 16 crores, let's say if you buy the inventory today at 16 crores, now you need and you receive converted into cash in, let's say, 30 days. That means that you are able to buy inventory and eventually get cash out of it in 30 days. Now, this is one cycle. Now, at a capital of 16 crores, we need to have this cycle 28 times to generate a revenue, to generate a COGS of 450 crores. That means we have to churn the capital 28 times in 1 year to buy inventory worth 450 crores. Like first time we bought the inventory for 16 crores, then one cycle completed, again buying for 16 crores. That's the cycle that we need to do 28 times. And if we convert in days, that means that inventory conversion from inventory to cash to inventory to cash should be done within 13 days. So but in infrastructure sector, this cycle takes 4 to 6 months. Now comparing from 13 days to 4 to 6 months, business, it is very difficult for business or nearly impossible for the business to have such capital churning so that the COGS would be worth 450 crores. So the balance sheet in this way, the balance sheet having capital of only 16 crores to generate a revenue of 500 crores and requiring 450 crores of COGS. So it wasn't, the balance sheet wasn't able to justify the projections that the business is making. And that's where Bharat sir went wrong. This is one of the major mistake that even a lot of investors, including myself, has made, which is not analyzing the company and the projections properly, or we can say lack of due diligence. That how does it come in? That we just assume that the company is old brand, then it will do good. The it is run by a business, second generation of entrepreneurs or second generation of owners, assuming that even they will be performing well. Again, third important aspect is whenever an activist shareholder he himself becomes the part of the management or the board of directors, at that time they become biased towards the company instead of the independent thinking that is required, that the company can do well. But when you become a part of the business, you become biased towards it, and you might become light-hearted that it is difficult to achieve the target. Whereas from an outsider perspective, you might not have the same uh, sort of thinking. So becoming the part of the shareholder, becoming the part of the board, becoming the part of the business, that had a lot of restrictions, and which restricted him to making the important changes or to view the business from an independent standpoint. And again, the last point, which is balance sheet didn't justify the projections. So these are some of the major mistakes that Bharat sir has had made in this investment. And even if anyone wants to become an activist investor, we really need to make sure of the biasness that comes in when you become the part of the board of directors, or not doing the proper due diligence, and because it is an established business or because it is run by a business family, it need not be the same case that just because they are part of the our business family, they will do good. So due diligence is important, understanding individual aspects of the business, opening the financial statement, understanding the financials. Those part cannot be skipped even the business is established, it is run by a business family or any sort of reason. So whenever we do this, the probability or the risk in the investment increases a lot. So this was a couple of understanding it related to the activist and style of investment, and some of the prominent mistakes that Bharat sir or even we as an investor could make, who needs to keep in mind. So that's all. These are the major learnings that we identified from the book, and I hope that we were able to help you understand these learnings, and look forward to your feedback in the comment section for the same. Thank you all.